Let's look at development finance. Development finance, as you know, is the most important thing in any development project, because if there's no finance, no matter how good a deal you've got, you will not be able to go ahead with it. Or if you run out of finance, then it's a problem. So it is very important that you understand how the development finance works. So let's look at what are banks looking for when they give you finance. First off, if I was to go and get finance off a bank for a development project, I usually don't go to them empty-handed, or just talk to them and say, okay, we're looking for a loan. I usually prepare a project report. And how to prepare a project report, I will explain you actually how to compile a project report. I'll explain you towards the end of this course. I think in module 12 we cover how to compile a project report. However, every module that we are going through, we're getting some information that actually becomes part of a project report. So I wouldn't go to a bank with empty-handed. So let's look at what's included in a project report. So it should have a project charter explaining you what the project is supposed to do, the scope of works, in the sense if there is a development management team there, what are they going to do and what the scope of work is going to be. There should be a risk management plan. There should be a demand and supply analysis, not necessarily in this order, and we'll discuss the order a little bit later. But demand and supply analysis, market research, there's demand and supply of what's happening there, that should be together here. Financial feasibility, most important. They will always ask for it. You will have to back what assumptions you've made in your financial feasibility, and we've discussed that. We've discussed financial feasibility in a lot of detail in the previous module. If you print out the input sheet and the summary sheet from the financial feasibility software that you've got, you should be able to put together a very impressive project report. So they will look at market comparables, they will look at permits, if you've got town planning permit or building permit, they will look at all your drawings and documentation, schedule of leases. If the property in question has a current lease on it, they will want to have a look at it. Pre-sale contracts and deposit receipts, they would want a valuation report, they would want your profile if you're a developer, whether it's your first project, second, third, fourth, fifth, and so on, and your financial data. And they will ask for some supporting documents, which would include property information like title, plans, land purchase contract, QS report. If you haven't got any, they might ask you to get one, because especially if it's a construction contract. If you have a construction contract in place with the builder, they would. If you've got a project management contract in place with somebody, and if you're doing this for the first time and you don't have the credibility or established developer profile, what you can do in this, and if you don't have a developer's profile, however you have a construction contract with a builder and the builder is strong, you can leverage off the builder's profile and add that in your project report, so that the banker knows that although you're doing it for the first time, but there's a very strong builder with a history of similar projects. So that actually adds a lot of credibility to your report. Not only that, if they see the report, they know that they are not dealing with schmucks. They are not dealing with first timers. They are dealing with somebody who knows what they're doing. So, and that's a very important aspect of getting your loan across the line. So, and they would want a marketing plan. So if you've got all these things in your project report and you present it well, apart from that, in your project charter, it should include your stakeholders. It should also include details of the borrowing entity, and so on. So if you've got these details in your project report, it will impress your lender. So that's one thing. If you go to a bank, make sure you don't go there empty-handed. Make sure you've got a report. Let's look at how does a lender evaluate a development loan. So when they are actually looking at your loan, what are the things that they are actually looking at? So there are quite a few things, and I'll go over them one by one. So first of all, some things could be repeat. They're looking for your credit history. They're also looking for relevant history or proposed development. So I don't know if you bought the project of somebody, or how long was the project was in the market for, and so on. So they wanna do their own risk assessment, in the sense that what type of project is it, what are the projected sales, if you've got any lease agreements there. So, and the way they mitigate their risk is that they look at the number of pre-sales you've got. They might lower the LVR, which is the loan to value ratio. They must have a tripartite agreement, which is basically the agreement that overrides construction contract. So if the builder for some reason goes bust, the bank steps in and would hand over the job to another builder and complete the job, because the bank's money is at stake as well. So it is in their interest that you complete, or the builder completes the construction. So basically the tripartite agreement is between the bank, builder, and the borrower. So they would also look at the fixed price turnkey construction contract, because banks always want a construction, irrespective of the kind of arrangement you've got with your building contractor. Banks would always want to see a fixed price construction contract. Developers life insurance. A lot of banks ask for it. In fact, I'm actually getting one for myself for a project that we are doing, and the lenders have asked for it. Lenders exposure in that suburb or area. For example, you go to XYZ Bank and you are developing in a suburb called ABC, and the XYZ Bank is already financing 10 different developments in the same suburb, ABC. And you go there with the 11th development that they want to finance. Although everything might stack up, they might still refuse the deal, because their exposure in that suburb is way more than their comfort level. So that's one thing you've got to remember as well. Banks like to see a development margin on cost of at least 15% for smaller projects and a minimum of 20% for larger projects. And we've discussed that in the feasibility in the financial feasibility module. Valuation, always I've got a separate module for valuation that we can look at after this. However, I'll just quickly explain. Make sure that you interact with the valuer yourself. Make sure that you get a list of valuers who are on your bank's panel, and you contact them directly, and you get in touch with them directly. And I'll explain that a little bit more, in more detail in the valuation module. So whatever you claim to your valuer, he will scrutinize that, and important, refer to valuation. Basically, I'm asking you to refer to the valuation module, because I talk a lot more about valuation in that. Actually, that should be valuations. Okay. Quality of security. In terms of the block of land that you are purchasing, or any other asset that you may have to cross-collateralize. So basically, they will look at, if there's not enough equity and the valuation comes in a little bit lower, they will look at any other collateral security that you can put forth for them, because the banks or the lenders always have to have two ways of getting paid. GRV, or the end value of the developed product. GRV stands for gross realization value. It helps if the GRV of the end product is at median value. So with GRV, all I'm trying to explain you or stress upon over here is that if the GRV of your end product is at the median value in that suburb, it actually helps with valuation. It may or may not be at that median value. It may be slightly above the median value, but if it is at the median value, you'll get really good valuations. Fire sale scenario, I always put that in my report. In fact, the no money down deal that I did, I had a normal feasibility, And then I had a fire sale scenario where if the market took a nosedive and we had to discount our properties by 100,000 lower than the market, were we still making money? And a lot of my investors who invested in that project really liked that, because I showed them the absolute worst case scenario, and we were still making money in that project. So that's one of the reasons we were able to put together the no money down deal. Area suburb of your development. Banks mitigate the risk by funding development area with a history of strong capital growth and a balanced demand and supply ratio. Financial strength of the developer. Obviously, they will want to see your track record and your financials. Interest rate. How do they determine the interest rate? Lender reviews costs of raising funds and determines the profit margin they must achieve. So that's the first thing that they will do. And based on their risk assessment of the project, they will look at what the risk involved. Lender's profit margin is based on risk taken by lender and the length of time these funds will be outstanding. And I'll give you an example. If the lender suspects the lend period will be short, the interest rate will be much higher. And I'm experiencing this as we speak. We've got a construction loan and it's only for 6 months, and they know it. We've already got 2 pre-sales. There's only one more pre-sale to go. One more sale to go. And we've got a construction program that we can finish the project in 6 months. And the interest rate has come out really, really high because it's only for a short period. Not only that, they've actually put another clause in it that if you pay it early, they would, if you pay it early out of our own funds, they will put a penalty of or put break costs of 3 months worth of interest. And I'll go through that with you a little bit later. If developers have if developers have a history with the bank, if developers have a history with the bank with substantial balance with the lender, profit margin may be reduced. So obviously, if you've got a history with the bank, they will look at it more favorably. Establishment fees and charges, in addition to interest rates. Apart from this, all this is add-on. So usually between 1 to 3% of total loan amount establishment fee. It might have, for example, the fees that we're paying in that is really, really high. It's 1.75%, which includes 0.25% commission for the agent, for the broker, and so on. And that's another way for them to reduce risk and increase their profit. Construction loan period, usually based on construction contracts. So whatever contract you present to the lender and whatever the build period in that contract is, they will go by that. So plus extra time. So say for example, your build period is 6 months, but you need extra 2 months to settle all the sales or pre-sales that you've got. So you would, in your feasibility, you would account for 8 months of finance. Terms and condition. Do they want extra equity? Do they want extra collateral? They would want personal guarantees. And if there are more than one party involved in that, for example, there's a development that we are doing here, and we are 3 different unit holders in it, and we are all jointly and severally responsible for it, which basically means that it's not necessarily the bank will go after anyone. It basically means that each borrower is liable for the loan of not only their share, but also the share of the other partner. So if something goes wrong, bank wouldn't care less about what shareholding you've got in the project. They would go after you to recover their loans. But in any case, if you go through, don't let that scare you, because that's just the way the industry works. And if you look at one of the videos in the first module we had, which was about overcoming fear in property development, I've discussed all of that. So don't get scared with all of this.